I'll point to a couple, and one of them first up is probably an asset class within our portfolio that is a little bit bespoke, and it's not necessarily part of an indexed REIT fund globally, and that's the preferred equity securities market in the United States. Our portfolio holds a position in a number of US REIT issues that are preferred securities. So what that means is basically a US REIT will have common equity, which is a REIT equity security, and then there'll be a preferred security in many instances that they've issued to the market, which sits in between that equity and debt on the balance sheet. So these hybrid type securities are preferable in nature to common equity. So if there was a theoretical wind up of a portfolio, the debt holders would get their funds back, then the preferred security holders, and then the equity holders. And when it comes to the cash flow waterfall from these groups' cash flow statement or income statement, they're paying interest on their debt, and then they're paying the preferred equity holders, which is us in many instances. Now, why this is an interesting component at this point in the market in particular, and has been through COVID, is the fact that a number of these preferred equity securities, which are publicly traded just like equities themselves, were trading at really big discounts to their par value, so the value that they'd be redeemed at. Yet the coupon payment or the dividend was still being made. So the yields on offer were exceptional, in some cases 8 to 11%. And then there's a number in the US, one of them is RPT Realty Trust, which owns a portfolio of open air strip retail shopping centres, but not retail malls in the traditional shopping centre sense that our listeners might realise. These are lower price point type retailers that focus on discretionary goods, but that are relatively less expensive in nature, and a customer's more likely to travel to buy them. And they've been performing quite well with their sales and rent receipts, but not well enough to be able to pay their common dividends, for example, through this period of time. However, they have paid their preferred equity security holders their dividend, and in many cases re-rated their share prices to their par value. So we've been able to pick up some really compelling risk-adjusted total returns, but the opportunities are still numerous and really on offer in a market like the US REIT preferred area. So that's probably one aspect of a holding I can point to. The other is, again in the US, this whole idea of retail and retail malls, and on the lower end of the spectrum, where we don't think about the larger enclosed malls with department store retailers, are the strip centres or the open air malls, and we're seeing a trend developing where a number of in-mall retailers are fed up with paying too high rents for no foot traffic, and, to put it crudely, no bang for their buck. So they're looking to off-mall areas in open air centres, and there's a number of REITs that we have on our coverage list, and one of them that was recently added to the portfolio is Sal Centres, which is, it owns about 80% of their portfolio is in the Washington DC or Maryland area, and obviously the US has gone through an election, which is looking like it's going to be a Democrat government, and Washington is the epicenter for that. And we'd likely see some good ingredients for not only off the back of the reopening trade when it comes, off the back of a vaccine, of course, but also some ingredients for rental tension from population growth, perhaps a growing workforce in that location. So that's another REIT that we have in the portfolio.